we start with this. How much would you pay for a Sam Adams right now? An ice cold Samuel Adams Boston Lager. How about if I told you you could have one for free? Actually, scratch that. How about if I told you you could have the entire company for free? For a very, very brief, unshining moment this afternoon, Wall Street valued the entire Boston Beer Company, the company that makes Sam Adams beer. Wall Street valued the entire company at precisely $0. Boston Beer was one of a number of companies who, in the bizarre flash crash that happened on Wall Street today, briefly saw its stock price go to zero. The company was worth $0. It wasn't the only one. A blog at the Wall Street Journal today rounded up some of the others. Exelon, one of the largest utility companies in the world, normally valued at about $30 billion, today was briefly worth $0. It was free. The stock price of Exelon was zero. Same goes for Accenture, the big consulting firm. Stock price at one point today, zero. The utility CenterPoint Energy, also stock price zero. The specialty pharmaceutical company Impax Labs, again, stock price at one point today, zero. Even if you don't know anything about the stock market, you can see from the stock prices in the graphs that we just put up that aside from the huge flash drop in the middle of the afternoon, the prices of shares of those companies was actually relatively steady today. They all went down a little bit from opening bell to closing bell, but nothing that would get them onto cable news shows that aren't usually about the stock market. Do you want to know even something weirder that happened today, even weirder than all of those stocks going to zero at one point? It wasn't just stocks dropping inexplicably to zero. The Journal also notes that at the same time that some companies were becoming free, becoming valued at absolutely nothing according to Wall Street, some other companies went off the charts in the other direction. The auction house Sotheby's, for example, which has the stock price bid, BID, get it? Bid, Sotheby's auction. Sotheby's started the day with its shares costing $34 and something. Sotheby's ended the day with its stock costing $33. It's a drop, but it's no big whoop, right? It goes between $34 and $33, whatever. Till you notice that in the middle of the day, at one point, the stock price of Sotheby's shares went to $100,000 per share, which means that at some point today, Sotheby's went from being a company worth $2.2 billion to being a company worth $6.8 trillion. Which means for a minute that one company had a net worth of somewhere between the size of the entire economies of the United States and China. Congratulations, Sotheby's. Bid high. Even for people who don't watch the stock market, what happened on the market today was nuts. It was crazy. And then almost as soon as it happened, the flash crash was over. I want you to watch this one insane minute of what happened on CNBC during this weird crash. It was again, this is a very specific moment in which this all happened this afternoon. Just watch what happened on CNBC. We always have this on in the background of the offices here, right? And on CNBC during this minute, they're talking about Procter & Gamble stocks. Watch this.
P&G is now down 25%.
Oh, well, if that's true. If that stock is there, you just go and buy it. It can't be there. That is not a real price.
That stock was down 2%.
Well, just go buy Procter.
All right? This is an unprecedented
Just go buy Procter & Gamble. They reported a decent quarter.
Is there a hedge fund that is liquidating? Is there a distressed seller?
Is there anything else that's happened?
A 49.25 bid for 50,000 Procter if I were at my hedge fund. I mean, this is a good opportunity.
They were just taking that point. I mean, that's an incredible. I mean, that name. Nothing has changed for Procter & Gamble in the past 4 minutes.
When I looked at it, it was a 61. I'm not that interested in it. It's at 47. Well, that's a different security entirely. So what you have to do, though, you have to use limit orders because Procter just jumped 7 points that I said I liked it at 49. So, I mean, you got to be careful. When Rick Santelli was saying, look, this is a dangerous market, what I am saying is you put in a 49 bid for 200 shares of Procter. If you get hit, fine. This is very much 1987-like, a little different from 2007-like. So in 1987, there was a breakdown where Procter goes from, say, 50 to 12, all right? And, you want to be there at 13. I mean,
Wait, look at it.
It's a fast market. Yes. It's a fast market.
The market was down 900 points. We're now down 688.
So remember, I buy 50,000 at 49. I now flip it at 59. I just made 500 G's.
I just made 500 G's. Anybody who just did what I just said to do just made hundreds of thousands of dollars, millions of dollars. Boom, and then it was over. The stocks go, boink, and then they come back up. The markets overall still ended up over 300 points down today. But at one point, they were down more than 1,000 points. NASDAQ and the New York Stock Exchange ultimately, late in the day, decided to do something kind of amazing. They decided to cancel, to annul all of the trades that took place in that crazy moment. They decided to annul all of the trades between 2:40 p.m. and 3 p.m. Eastern if those trades showed a fluctuation of more than 60% of what they were before the flash crash. What on earth happened today? Joining us now is Shannon Zimmerman, the senior analyst at the Motley Fool, an online investment website. Shannon, thanks very much for being here and helping us make some sense of this.
Great to be with you, Rachel.
What can you tell me as a person who doesn't follow financial news that closely, doesn't know that much about markets, what can you tell me about what happened today?
Well, Boston Beer went to zero because it's priceless. You gotta love Sam Adams. Basically, the market history shows that if you have a rally where you have come as far and as fast as we have since the March 2009 lows, there's a psychological aspect to this where people are expecting a kind of correction, and so you have what's going on in Greece, which is a serious story. That's been in the atmospherics for quite a while now, and so people are expecting a correction. You have Greece happening, and then somebody fat fingers a key. Well, lo and behold, you have a big crash, which we had temporarily, at least today.
Hold on. Somebody fat fingers a key. What are you talking about?
Now, this is not confirmed, as I understand it, but a trader hit a B rather than an M, as in billion rather than million, and these were S&P future contracts, and that sort of caused a cascade and a domino effect across the market, and that was a big factor.
Hold on. Now, this is MSNBC, not CNBC, and I'm an idiot when it comes to this stuff. So somebody's buying...
I don't believe that for a second.
Somebody is buying futures, right, on a particular stock, on the market doing a particular thing?
In this case, according to reports, it's on the market doing a particular thing, S&P futures contracts. Okay. And the magnitude of the order was quite a bit larger than the trader intended. Maybe he was using one of the virtual keyboards on his iPad, and he fat-fingered it, and that caused a big ripple
the trader's
effect.
trying to buy X million futures, buys X billion futures, and the market goes... And does the market freak out because one guy does that because systems are automated to follow individual large trades like that? Or does the market freak out because actual human beings are freaked out by what this guy did wrong?
Well, it's a little bit of both. So yes, there are machine glitches and machine rules, and so certain things happen, and machine trading kicks in. But then once the market sees that, and you can't, it's an efficient market most of the time, but you can't process news in real time, and so people panic and they think it's the bad old days of late 2008. Lo and behold, I got to get out of the market, and a lot of people did. It looks like a lot of those transactions that happened as a result of the glitch are going to be rescinded. There may be some pushback on that from the people who were the counterparties actually made money, but I think that's probably a wise decision.
So all of these, a bunch of stocks, as we described, go to zero. Some other stocks bizarrely go to $100,000 a share from the $30 a share territory. A few people who are either lucky or very quick on the trigger make zillions of dollars off of this wild market fluctuation. The people who profited off it, as well as the people who lost off this fluctuation, will both expect to be made whole, both expect to be brought back to where they were before this glitch happened because of the canceling of the trades?
Well, obviously, if you profited from the trade, you probably don't want to be made whole in the reverse direction. That's going to be the rub that the exchanges will have to deal with. But Sotheby's, they had a Picasso record, I do believe, so maybe that accounted for some of their pop.
In terms of the glitch being corrected, in terms of trying to figure out what went wrong, whether or not something like this could happen to the market again, which is obviously not something that makes people feel very confident in our financial infrastructure, there remains the substantive issue, the non-process issue of Greece. Why is Greece something that's responsible for markets actually losing significant percentage around the globe, including our own?
Well, right, that's a good question. So the fat finger is like slapstick farce, and what's happening in Greece is a real tragedy. And so that's been hanging over the markets for several days now, and the bailout, folks thought would contain that, but apparently that's not the case. And so really, and your viewers are probably readers, or many are readers of Paul Krugman. He's written quite intelligently about this, and there's a way in which the EU could come unraveled, but there's a forced marriage in some respects of very economically strong countries in absolute terms and relative terms, terms, like Germany and UK and France, and then weaker countries as well. It's not like the United States. There are disparate interests and sometimes very, very much competing interests in terms of the economy. And so, when Germany pushes back on the yield that Greece is going to have to pay on the debt it issues, and I know this is a bit technical, but essentially, how much interest are you going to have to pay on the money that you're going to borrow? Well, that was sort of presaging the dust-up that happened, and then Germany kind of relented, but we'll see how much longer that lasts, because if you don't share common economic interests, as the Eurozone doesn't always, that's a somewhat problematic question to answer.
Enough to unsettle and agitate markets worldwide, certainly not quite
Absolutely.
As dramatically as the guy hitting the B instead of the M key while trying to make that one trade. Shannon Zimmerman, senior analyst at The Motley Fool, thanks very much for your time tonight. I appreciate it.
Great to be with you.